So, dil picture mein dialogue hai, patti to patti varna rakhi ready. So you had no downside. So if you don't have a downside, the only thing that you can, do is, go on the higher pedestal. And I think that's where we are today in terms of the understanding and the awareness questions. When it comes to fixed income, people say the mindset is they want fixed return, or I would say a short return. And nothing of that sort is possible actually when you invest in the market route, because even one's life is not really assured or guaranteed. What are we talking about returns?
Today, we have someone on our show really who has been somewhat of a trailblazer in the asset management industry in India. And we'll get to that in a second. But please do join me in welcoming Lakshmi Iyer onto the show today.
The entire journey through the last 2 decades plus, it has been fool or kaate both, obviously, because there is barely a rose without a thorn. And yeah, kabhi khushi, kabhi gham for you to own a diversified pool called the mutual fund. And within that mutual fund, you get to assume a credit risk. And you also get to assume an interest rate risk. Aate waqt to sab bolte hain, we are all 3-year investors and 4-year investors, and every 3 months they keep looking at their investments, which is a boon and a bane both. More a bane from a fund management standpoint. The stock that you should be long is the stock called India, and after that, there should really be no conversation. And of course, or I would say more than 95% of your returns is attributed to the right asset allocation that you do, and that obviously is a function of the risk appetite that you have.
Hello, everyone. Welcome to another exciting episode of Talks with Daulat, where we aim to deconstruct the seemingly complex world of finance and empower investors to take better and relevant investment decisions. My name is Varun Fatehpuria, and I am the founder and CEO of Daulat Wealth Management. Today, we have someone on our show really who has been somewhat of a trailblazer in the asset management industry in India. And we'll get to that in a second, but please do join me in welcoming Lakshmi Iyer onto the show today. Lakshmi is hi Lakshmi. Lakshmi is the CEO of investment advisory at Kotak Alternate Asset Manager, the Kotak Group's alternates business. She has been with the Kotak Group for over 23 years now. As part of her current role, she is responsible for investment advisory and product solutions across fixed income, equities, real estate, and alternates. Prior to her current role, she was the CIO of the fixed income business, primarily overseeing its debt mutual fund. Prior to joining Kotak, Lakshmi started her career with Credence Analytics, where she was responsible for tracking the corporate bond markets and generated research reports. She holds an MBA in finance from Narsi Munji Institute of Management Studies. Lakshmi has actually been recognized as one of the top 25 most influential women in asset management in Asia by Asian investors. Outside of work, she loves exploring new places for traveling, is a big food lover, and for all of you who would be probably following her with the pick of the day tweets on Twitter, she's obviously a huge movie buff. So, Lakshmi, it is a pleasure to have you join us today.
Thank you so much, Varun. Thanks a lot.
Lakshmi, let's just rewind the clock a bit, going back to when you just graduated and completed your MBA and wanted to pursue a career in finance, right? So how did that experience look like? Because as I can imagine, obviously not a huge representation of women in the finance industry. That is something that you have continued to, sort of challenge over the last 20, 25 years that you have been in the industry. How has that journey personally looked like for you?
So, to start with, if you ask me, was this all envisaged? Was it all planned, in a methodical manner, the way people, usually try to plan their stuff? The answer is absolute no. If you see that movie Dil Chahta Hai, this guy has this fetish of recalling the date, the time, where people met and what they exchanged and stuff like that. Nothing of that sort happened for me. For me, it was more about one basic fact that was etched into me is that it was my love for numbers. That's something which was there with me from school days, and then all along the right brain, which is the creative quotient, or maybe the art side, was less, I would say, active compared to the left side of the brain, which was more analytics and rational driven. And I think all along, that is what the thought process was, that कुछ करना है तो वहीं पे करना है. But obviously, it was never planned that I want to move into asset management, I want to move into listed public market space, or then make my move. Of course, things start getting slightly more streamlined as you move up the corporate ladder. But yeah, I think if I summarize, the entire journey through the last 2 decades plus, it has been fool or kaate both, obviously, because there is barely a rose without a thorn. And yeah, kabhi khushi, kabhi gum. I think those are the kind of moments, because you can't always have, even fairy tale have glitches, and they also have their Rapunzel moments. So I think you have all of that. But when I look back, I think I feel extremely satisfied, say, that whenever there were temptations to kind of put in the brake, I only thought of accelerating. I think that is the only saving grace, I would say.
Absolutely. I think if you were to sort of like, go back in time, I think again, you're sort of like, freshly out of school, still figuring out what to do. And then I think circa 2005, you really get this opportunity to manage the debt side of business, right? You sort of like lurched into these asset management space with the mutual fund in a country where people are in love with FDs, right? Uh, what for you personally, how did you sort of like, get into the space, and what was that experience like trying to explain to investors what this entire concept around debt mutual fund is, and how has that worked, and how has that really developed over the last 17, 18 years?
So, Varun, the fixed income piece remained very unexplored, even 2 decades back. And even now, the fetish, or the magnetic pull, as I call the chumbak factor, still continues to be a fixed deposit kind of investment opportunities. Because when it comes to fixed income, people say the mindset is they want fixed return, or I would say a short return, and nothing of that sort is possible actually when you invest in the market route. Because even one's life is not really assured or guaranteed. What are we talking about returns? So when you come from that plinth, and take up that challenge, saying that, okay, here is this slightly difficult feat, where banks obviously will be able to effortlessly, or on a relative basis, be able to pull in more pools of capital, whereas when you are managing monies, with fixed income orientation, it's going to be that much more difficult. So I think you try to do a lot of storytelling, and I think the storytelling part really appeals with the investment fraternity. You take absolute basic examples, and not try to excessively complicate stuff, and that has to be with consistency. It cannot be a one night stance, कि आज आपने जाके समझा दिया, and then after that, if the investor is not convinced, then you said नहीं, उसको जाने दो. So I think it's been a series of such seeds which have been germinated along the way, and then that is how you are seeing the net result, with that sapling and then growing into a plant, and if, wherever the case is, it grows into a full blown tree. Are we at the tip of the iceberg? Probably no. Have we arrived completely at the fag end of the tunnel? Again, the answer is no. But we are definitely way ahead in terms of the journey, collectively, with the industry having explained in very simplistic terms. Obviously, sometimes the interest rate environment also played advantages, and multi layer approach, where almost everyone was speaking a similar language. So I think a combination of all of these clearly meant that the awareness levels only had to go up, and आपका base इतना छोटा था that there was hardly anything to lose. So दिल picture में dialogue है, पट्टी तो पट्टी वरना राखी ready. So you had no downside. So if you don't have a downside, the only thing that you can do is go on the higher pedestal, and I think that's where we are today in terms of the understanding and the awareness quotient.
So one of the point, Lakshmi, which you mentioned, which sort of like, provides me a very good segue, that the storytelling, right? I think if we look back, I think prior to 1st April 2023, right, the entire storytelling around debt mutual fund was around indexation benefit. To be honest, I think that is how it was sold to retail investors, right? And then now come 1st April 2023, you have this entire indexation benefit being taken away from debt mutual funds. The taxation is at par with other fixed income instruments. Yes, you had other products which had come up in the form of target maturity funds, where you could tell investors that you have a high visibility of return, right? But today, as an investor, as a layman, why should he or she still commit to investing into a debt mutual fund with all sort of a volatility, trying to generate that probably extra 50 bips or 75 bips of returns? I mean, why should he still consider today?
Thanks to your question, Varun. One is that a mutual fund is one of the vehicles of participating into any asset class, and in this case, it is fixed income. There are other ways in which you can actually participate into this asset class, and with the indexation benefit going off, everything has become every vehicle has come to a level playing field. It's like this, if somebody tells you that. If you drive and if you take a train and if you fly, the distance, the time taken is going to be the same. Or if you take a ro-ro, for example, just as a means of transport, to give you a classic analogy, it becomes a level playing field. But sometimes it's not, or rather most of the times it's not, given the distance covered. Flight is far more efficient, depending on which geography you're traveling. So I think fixed income investors are also looking like they are gravitating towards different vehicles of ownership of this asset class. And clearly, the direct ownership of some of these bonds and the AIF platform have clearly been one of the beneficiaries. And they also offer the benefit of diversification. If you talk about the AIF, you get to pick and choose the credit that you like, if it's concerning direct bonds. So I think this has actually opened up a plethora of ways and means. So from a horse-blinded approach, which was typically the case, I think the horizons have started broadening. So that is point number one. Point number two is, does that mean that there is absolutely no case to own mutual funds, in the fixed income asset class? Well, that's not necessarily true, because today, for an absolute retail investor who has very limited understanding of the financial markets, or is the relatively uninitiated person in the world of finance, it will still make sense for you to own a diversified pool called the mutual fund. And within that mutual fund, you get to assume a credit risk, and you also get to assume an interest rate risk. So if interest rates actually go up, and you want the opportunity to participate, you are better off as as I said, a retail investor who has a very limited time and bandwidth, and of course understanding you can use that route. And as you get more evolved, you can actually start digging into the direct bonds as well as the alternate investment fund route. So yes, to answer your question in very, very yes, no kind of parlance, incrementally, are they losing appeal? The answer is yes, because there are other opportunities which have opened up. But is it a complete slam dunk that there cannot be any more inflows? I think that's not true. So I think that avenue will continue to be one of the potent sources of investments.
And while we are at it, I think we talked about the two crucial concept of a fixed income mutual fund is the interest rate risk and the credit risk. Now you have something like in April 2020 come up where one of the mutual fund obviously did not handle the credit risk side of things so well. That also sort of lends very well to the point that are these liquid vehicles, that 24-hour liquidity, are they well suited to take on credit risk, where probably I think if they would have had the time, they obviously did an extremely good job in having a gated structure where you give the fund the time to see through the credit events. But when you have the retail investors all across the country pounce at the same time trying to withdraw money, I think that sort of like accelerates the impending problem that you have. So our credit risk, are mutual funds still a very good vehicle to take on those credit risk?
Maybe, maybe not. It depends on what kind of underlying that actually populates in your portfolio. So, for example, if you take the case of April 2020, when the episode occurred, it was not a credit event. It was actually a and the nature of the corporate bond market is such where even to liquidate a AAA bond, if there is, say, a huge beeline of rush to exit a particular fund, it cannot, happen without impacting some, few basis points in terms of impact. Of course, relatively lower compared. So, in the pecking order, government bonds are the most liquid, followed by the AAA PSU or the PFI bonds, and then of course the others come in that lower pecking order. So I think the answer to that also would be that there have to be certain bells and whistles, and therefore we saw liquidity ratio equivalent, etc., being introduced into mutual funds. So after that, things have become much more streamlined. Also, the short termism, typically mutual fund investor comes in with very short term orientation, in terms of horizon, longevity of investments. आते वक्त तो सब बोलते हैं we are all 3-year investors and 4-year investors, and every 3 months they keep looking at their investments, which is a boon and a bane both. More a bane from a fund management standpoint. So closed-ended structures are better geared to be able to manage these kind of risks. Or if you have an open-ended structure, then obviously you need to have a significant cushion of high-grade assets, which is a AAA and the cash equivalent, which is what we have seen as a regulatory body. We've seen those introductions. So that way, quite a good amount of risk mitigation, if you see right now, has happened. But that's a boon part. The bane part is, therefore, it tends to dilute the gross yields on the portfolio. So for an investor who is looking at adventure, and when I say adventure, in the sense that somebody is very happy doing just a merry-go-round, somebody says that I'm very happy with a bungee, I don't feel the dizziness in my head. I think that gradient of the investor mapping is now set right. So for those preferring the latter, you clearly have the alternate investment funds.
Got it. And obviously, I think that is also the reason why we are seeing so much of interest in the private credit space, right? I think you want to term it whatever you want to term it. The industry will give 10 different kind of name to make it look fancy. But I think that is partially why we have seen so much of the money actually trying to move out of the fixed income credit risk space to AIF, because the structure itself sort of like lends well to the entire concept of lending to sort of like less liquid companies in a country where the bond markets continue to not be so well developed. So moving on to your current role, Lakshmi, for the benefit of our audience today, if you could just explain what does alternate in its true sense actually means. I mean, today someone will tell real estate is an alternate business, gold is an alternate asset class, but what does alternate as an asset class really mean?
No, so effectively, what doesn't come in the public market space, whether it is in the private equity space, whether it is in the strategic situation space, or whether it's in the structured credit space, it could be very early stage equity financing, it could be late stage equity financing, it could be hybrid structures where you do a coupon bearing bond with some upside in the form of an equity return. I think a combination of either or all of these. It could be investments in data centers. It could be, so I think all of this is what encompasses the alternate space, and it offers the entire gamut of opportunities, with the beauty being that the asset manager is not under pressure to deploy money as of yesterday. The structure and the mechanism is so beautiful that there is a commitment amount when the fundraise is underway, and subsequent to that, only when there is an investment opportunity is the call for money made, ranging from 5 rupees to 25 or 50 bucks, as the case may be. So that, in a nutshell, is what this industry is all about.
So today, as a retail investor, let's say someone who has an investable corpus of 5 to let's say 5 crores, for example, what percentage of the portfolio ideally should one look at in allocating alternate? And I'm not trying to be a bit prescriptive over here, but just trying to give the audience a sense of how they should be looking at this alternate asset class, right? Because I think any amount lesser than that, we typically advise that probably it is not a very good fit if you're concentrated again in specific sub asset classes within alternates as well.
So, Varun, most of these AIF structures are closed-ended in nature, which means most of them, okay, unless you're doing a public market equities kind of space, which has open-ended and periodic liquidity, most of the alternate underlying assets come with a finite period, which could be ranging from lower end of 4 to 5 years to upper end of 10 to 11, 12 years. So the primary question before embarking on any such investment opportunity is that how much of money I am willing to risk to complete isolation and not available at beck and call kind of status. I think that's the most important question which any genre of investor should seek to answer. Where your liquidity is of paramount importance, your veering towards these kind of asset classes will be absolute tail end. But if you are an institutional investor and you are saying that, look, the delta driver, which is likely to accrue to me over the next maybe 5 years or 10 years, depending on the nature of the underlying, if that delta is what is of most important, reckoning for me, notwithstanding the liquidity compromise that I would like to do, then obviously it could be a reasonable core allocation from a portfolio standpoint. In our experience of fundraising and capital raising, we have seen that largely the Indian pool of capital, the primary drivers of wealth creation is predominantly equities from an asset allocation perspective, which is the public market listed equity space, followed by fixed income as an asset allocator, maybe some element of gold. And the alternates allocation range anywhere between, say, lower end of 5% to higher end of 15%. That number could be north of 20 to 25 or even 30% if you're talking about institutional investors, especially in the foreign, territories. So I think there is no cookie cutter approach to answer this question. The underlying nature of the asset class, and of course, given the fact that you are going to be compromising on liquidity, has to be the bigger driver of your allocation.
One of the common feedbacks that when we go out and speak to a lot of the investors, primarily HNIs and UHNIs, is that obviously I think the penetration of alternatives have increased over the last 5 to 7 years. One of the common complaints that we often hear is the lack of a standardized benchmark, right? You could come and showcase an investor some numbers, but someone who's probably not very deep into it will probably get a bit lopsided and confused with respect to what exactly is the underlying benchmark, and am I really getting the benefit of taking that additional risk adjusted? So what do you have as an industry? I think SEBI also has done or trying to move to a standardized benchmarking, but again, the gamut of product tends to be so different from asset manager to asset manager that pinpointing onto a benchmark, I'm presuming, could be really difficult.
No, your assumption is absolutely correct. The heterogeneity, of the underlying asset class itself makes it very difficult to get nuanced and very prescriptive on a common benchmark like we have for the public market space. It's not that it's impossible, but it's not very pragmatic that you and me are running two different strategies under, say, for example, if it's a category 2 AIF, for instance, but our ambit of operating, say, even within the structured credit or performing credit space, you might be probably in the 11 to 13% or 14% region. I could be in the 14 to 17% region, and my neighbor could be in the 18 to 20, 21% region. We all could be called as structured credit, performing credit, as a private credit, whatever name you can call it, but the benchmark cannot be the same. So I think these are some of the live challenges as we speak, which continue to be there. But my point is very different. My point is that these strategies or these funds are not really benchmark hugging strategies. These are very, very different propositions. I mean, if I am doing a land deal in Mumbai or in Noida or in Pune, what should be my benchmark? And at the same time, if two of us have launched a fund, you are doing a transaction in Bangalore and I am doing a transaction in Mumbai, and the contours of the transaction could be very, very different. The timing of the fund launch and the fundraise could be very similar, and we would be categorized under the RE or the real estate category. So I think these are some of the live considerations which need to be borne in mind, which is why alternate investment funds are actually meant for the slightly more evolved customer, and which is why the threshold is higher. In fact, I'd be very happy to see the threshold, further going up than coming down. Coming down to sawal nahi hai, but
Right.
I'm saying that there is a lot of merit in seeing the threshold being increased, or try to uh, make your disclosures in such a manner that the investor knows what he or she is getting into.
Absolutely. Just switching gears, Lakshmi, here a bit. I mean, just taking a more of a macro perspective over here. Morgan Stanley recently upgraded India to overweight, right? Whatever context in that, I think means I think people again tend to focus a lot on what global financial institutions and how are they viewing the country, right? In your conversations with a lot of the institutional investors, both domestic but also global, how has the sentiment shift really occurred in India? Is it more of an allocation shift from China because they are not finding enough of an investable opportunities for their emerging markets allocation? Or do you see a genuine on the ground shift where global investors want an allocation to the country?
So, Varun, when I do my roadshows, whether it's in India or outside India, I usually have a pitch book, about the India macro story and all of that, which could be maybe 25 to 30 slides. But on a lighter vein, I actually ask them, I have just one slide, which says that the stock that you should be long is the stock called India. And after that, there should really be no conversation. And of course, if you want to deep dive further, the sheer size of the economy has not, and of course its demographics has not really prevented it from growing and recouping faster and stronger after the pandemic phase, which grappled the whole of the world. So when China is in a deflation mode, US is still figuring out whether they are in recession or they are in an expansionary mode. Eurozone is trying to sometimes ape China, and at other times the US, and Japan is partying because their stock market is doing better than the China stock market. You clearly seem to be like an oasis in the desert, and of course there could be sandstorms, no doubt about it. But the point is, how do you weather these sandstorms? And move ahead and allocate capitals to India basis the pure merit of the underlying. If you look at the Indian banking sector NPA, we are at an 8-year low. If you look at the corporate profitability of India Inc., it is marching. It's following the Olympic motto of faster, higher, stronger. So I think some of these things cannot be wished away with. So I think in terms of, I was in Japan last month, and I was just joking, with some of my colleagues that India jitna bolo jukawat utni hoti hai, like literally it's like a 90-degree bend. I mean, that's on a lighter wind, but that's the kind of excitement, and that's the kind of visible, I would say, stamina I am seeing in my conversations with investors. And I think, as I said, this is geography agnostic. We are seeing people also wait on the sidelines, citing that India is an expensive market, but the point is that, are we going to continue to command the premium? The answer is yes. So in the long term journey, but if you ask me, will there be speed breakers? Well, the answer is yes. Will there be bump downs? The answer is obviously yes. But will that derail the India story or derail the India wealth generating potential? The answer is no. It could probably delay it, but derailing is clearly not on the cards.
We have obviously a major event coming up, which is the elections in 2024, right? And obviously, in right mind, it is very difficult at this point in time to exactly uh, sort of like foresee what really effect the outcome of the election would have. But just sort of, if we were to rewind the clock back from 2024 to 2023 to where we are, in your understanding, how big of these events actually play into the narrative of where the stock market is actually headed? When we go and speak to investors, obviously they want a very cohesive strategy, cohesive story of, elections are this sector is going to do well, that sector is going to do well. But again, I think remaining diversified is something that obviously works well for most investors. How do you deal with that?
So as I said, events will come, events will go. Some events will have long-lasting impact. Some could be more psychological impact. But as I said, and again, I say this, quite often, when I meet my, fund management team. What happens? What was happening through the pandemic? There was a visible consumption slowdown. But did you stop drinking your tea, for example? Did you stop having your biscuit with your tea if you were already having it? Did you stop using shampoo for your hair when you had a hair wash? Okay, I'm not talking about rural India right now, but yes, I'm just talking about some of the conversations I was having with my colleagues. And well, the answer to each of that was a very, very glaring no. So I think some of these will continue to remain as the mainstay. So if corporate India is obviously a function of what kind of earnings potential it is going to tend to generate, and markets ultimately are going to be slaves of earnings. Well, a political outcome, again, to my previous point that we discussed, can delay or can offer some delayed gratification if the outcome may not be as per what you expected or as per what the markets expected. Markets have this uncanny ability to discount events way ahead of its happening. So if the markets are discounting a particular outcome and it doesn't happen, it's but natural that you are going to feel disappointed, and that will reflect in the market momentum. But as I said, is it going to completely puncture that you need a stepney and you say that, okay, now I'm not going to use it? The answer is no. The sheer underlying nature of the business, very, very incipient signs of capex coming underway, all that point towards the fact that all of these are going to be more temporary speed breakers, but it's not likely to puncture the momentum and the trajectory of the India growth story.
Absolutely, Lakshmi. And finally, just coming to our last question, I think someone, and as a professional, you spend a lot of time with a lot of people. I think probably some of the most influential people in the finance industry. But what does Lakshmi Iyer as a personal investor? How do you view your own money management thing? You could be sort of like extremely complex, or how do you manage your own money?
No, in fact, Varun, I'm a very, very boring investor. I'm a very simple investor. I'm not a broker's delight, for example. So I don't do momentum trading. In fact, my investments kind of follow the principle of fill it, shut it, and forget it. The broader mapping, which needs to be done is that of asset allocation, because more than 90% of your, or I would say more than 95% of your returns is attributed to the right asset allocation that you do. And that obviously is a function of the risk appetite that you have. So I think that is where considerable time and energy is where I expend to try to create that. And once having done that, it's more of course correction and small reviews as you go along. Dahej mein Kotak Bank milta hai as ESOP, so that's the only thing that I hold in my stock holdings. But every other portfolio allocation is through diversified underlying funds, and I think. And again, it's not that because we don't understand, or I don't understand any of this. It's just that professional life demands its own time, and obviously you are doing that, and which is true for any other investor today who obviously has an active professional life. So you are better off curating a portfolio basis your risk appetite, and just do course corrections as and when needed. And that is why I said I am a very, very boring investor, not a broker's delight, and I like to keep it simple. Complicating stuff will only mean trying to aggravate anxieties and pain points and apprehensions in the not so good times. So lage raho. And I think if you believe that if the future is bright, see, I am an eternal optimist. By birth, I'm B positive, which is a very common blood group, but it's not a very common attitude. So, once you actually cultivate that attitude, then I think being long-term, lethargic, boring investors, I always believe that let your portfolio sleep, like what Kumbhakaran used to do. And obviously you require that Nagada dole, to actually wake up your portfolio only if you believe there has been a substantive, or if you believe that there's a war kind of a situation. Otherwise, just let it sleep and do its work.
Yeah, I hope the audience today, take away some of the key points which Lakshmi just mentioned, and I think it sort of like pays in the long term to be boring, right? I think unnecessarily adding complexity to your portfolio by trying to keep yourself active and trying to make sense of the situation, which you probably not be would be better off than, let's say, the average guy right next to you. But Lakshmi, thank you so much for doing this. I think it was a delight to have you on our show today. We obviously always want experts to come and speak to our audience, speak to our investors, so that they can hear from the horse's mouth exactly what goes on behind their portfolios and how their money is actually being managed by professional fund managers. So thank you so much for doing this, and for all our audience, please do subscribe to us if you did like this conversation.
Perfect. Great. Thank you so much, Varun. Bye. See
Oh,
you.
yeah.